On Friday, June 19th, the Central Bank of the Russian Federation just might cut interest rates to either 5% or to 4.5%, the lowest that they will have been since the collapse of the Soviet Union. Within the context of this potential rate cut, there's a couple of very interesting things going on. First, this is the third economic recession that Russia has experienced since the year 2008. But there's a very interesting difference between the current recession and previous ones. In 2008, and then again in 2015 and 16 when oil prices fell sharply, the Russian currency fell dramatically, falling about 40% in 2008, 2009, and about 60% between 2014 and 2016. In both of those cases, inflation spiked and the central bank sent interest rates dramatically higher. This time, the central bank is cutting interest rates in part because the Russian ruble has actually been fairly stable in the face of falling oil prices, this time coming down only about 12% versus the US dollar so far this year. In any case, if Russia does cut interest rates, it also speaks to the fact that they can stimulate their economy through monetary policy. This is a very sharp contrast to countries like the United States or the nations of the European Union or Japan, who are blocked at zero interest rates and are therefore relying mainly on fiscal stimulus. I'm Eric Norland, senior economist with the CME Group in London.